Good morning, everybody. Happy Thursday. Who has two thumbs and is on time? Me. Who's actually here? Me. As always, we'll give everyone a few minutes to jump on in. I'm glad to finally be back with you guys. It's been, I don't want to say a long couple weeks because it's actually been great, but we had the deadline on October 15th, and I was kind of I think it was allergies at that point. I was just having some really bad allergy attacks and just not feeling great, and trying to get through the deadline. So that was tough. And then we had fall break. My kids had fall break. And we went up to Steamboat here in Colorado for the week. And toward the end of that, I got a cold. And so that was rough. And then all last week, it was just kind of up and down. I'd feel good one day, and then I just would feel lousy. And then for like last week, I felt great, but I've had this cough. So I don't know. So I don't know about anyone else here, but it has been a year and a half since I've been sick. We quarantined hard, and we haven't really seen a lot of people. So I think the last time I was sick was the beginning of tax season in 2020. So this has been so it's just like fighting this nonsense. So as you guys jump in, I see you guys jumping in. Let me know that you can hear me. I always am so worried about that. It sounds like I said my mic was working. I can hear myself in my earpiece, so I'm pretty sure y'all can hear me. But let me know that. And let me know where you're watching from. I'd love to know where y'all join me from every live. So go ahead and join. Let me know that. And hi, Karen. Sorry, I will actually try to, I will try to mute when I do that because that is just gross. But yeah, let me know where you're watching from. Yep, I know you. Well, actually, Karen, I think you kind of move every once in a while, right? Like not move, but you travel. So glad you're back in South Carolina. So we have a few updates, you guys. So I'll go ahead and jump in since there are a few of you guys here. A quick reminder, guys, this is a Q&A for you guys first and foremost. So when you guys show up, please ask your questions that you have. We're in the middle. We have 2 months left in the tax year or in the calendar year. Not everything is tax related, Brie. We have 2 months left in the year. So, whatever questions you guys might have, please, please, please let me know in the chat. Otherwise, we have a few updates. I was really, really hoping that by the time I came back here to be with you all, that we would have this infrastructure this infrastructure bill passed, because it could include stuff that affects us in the tax world. It may or may not. Right now, it doesn't. But I don't know if you guys watch the news, you hear the news. The newest suggestion or the newest piece that's being talked about being added to this infrastructure bill is getting rid of that $10,000 cap on the SALT limitation on your Schedule A. So let's talk about that real quick. So on your 1040, on your individual 1040, you guys may take the standard deduction or you might itemize. You only itemize when you have itemized deductions that exceed whatever the standard deduction is for the year. All right. And that standard deduction raises each year. I think last year was $12,400. I'm not positive that what it is this year, probably $12,600 per person. Don't quote me on that though. Haven't even started on 2021 stuff yet, guys. Still working through 2020 returns. But if your itemized deductions, which is the total of all of these things I'll talk to you about in just a second, exceed that standard deduction, then you're going to want to itemize and file a Schedule A with your 1040. And those itemized deductions are, what's included in those. It's certain medical expenses over a certain threshold based on your income. It is your income tax, your state income tax. So the tax section, and that's what we'll come back to, is state and SALT, state and local taxes. It's also, so it includes your state income tax. If you have local income taxes, it includes that. If you paid property taxes or real estate taxes, it would include that. So all of your taxes that qualify are lumped into that bucket. And right now, as of the Tax Cuts and Jobs Act that passed, that went into effect in 2018, that number, that tax number that goes into your Schedule A was limited to $10,000. This was a big deal for high income earners, right? Because and that's what you hear about a lot when you talk about right now, when they're talking about whether to include it or not, is because they talk about it being a tax break for the rich. Yes and no, and we'll circle back around to that real quick. Let me just kind of finish talking about itemized deductions. Your mortgage interest on your primary residence is also included in that, and typically your charitable contributions as well. So two potential things that are one potential, one past thing that I want to talk about today in terms of those itemized deductions. So the first is this potential, guys, again, it's a potential increase to that SALT limitation. So right now, the tax portion of your itemized deductions on Schedule A, as of starting in 2018, that tax number became limited to $10,000. So you could only deduct $10,000 of all the qualifying taxes on your Schedule A as an itemized deduction. This, like again, they're going to talk about high income earners, and yes, that's true, but it also hits hard in places that have high property taxes. You may not be rich, you may not be the top, 20% or whatever they're saying this really helps, but you could just have high property taxes. So California, New York, Texas, those of you that have those high property tax states on your primary residence are limited to that $10,000. It also hit hard on people who live in states with high income tax rates. Again, New York, California being the two that always come to mind, because it's state and local taxes that are included in that line item. So that is one thing to kind of keep an eye on in this infrastructure bill. As of right now, that's the only thing. There's not really any other tax stuff in this bill as it sits now. This one, I believe it's passed the House. It's waiting to get approved by the Senate, but we've been waiting for this thing for a while now. So we'll have to see what comes of it. But that is really the only piece. There is no additional COVID or pandemic guidance in this infrastructure bill, guys. There's no more PPP. There's no extension of unemployment. There's nothing in there but that. It is mostly an infrastructure bill with a few little things, as always in politics, hidden in there. Not hidden in there, but tucked away in there. So that is that. So let's talk about, so this week, the IRS, every week, every couple of days, the IRS releases stuff, reminders to taxpayers about what's going on. This week, the two big ones. So at the beginning of this week, they wanted to let y'all know that they have issued another 430,000 refunds based on that adjustment related to unemployment compensation. So if you're like, wait, what are you talking about? So 2020, a lot of people on unemployment, right? A lot of us. And typically unemployment income is taxed. It's earned income. It's replacing your earned wages. Therefore, it's taxed just like any other earned income. In March, middle or end of March of this year, they decided that the first $10,300 of unemployment income for people under a certain threshold, and I can't remember the threshold off of the top of my head, but that first $10,300 was going to be tax-free. However, some people had already filed the tax return, right? We start filing tax returns probably February 1st. We were waiting for those forms. Most of those forms are supposed to be issued by January 31st. So we have clients, and there's taxpayers out there, not clients, just all taxpayers who are filing those returns as soon as possible. So the question back then was, well, what do you do if you already filed your tax return and you had unemployment income, but you were taxed on it? Well, the IRS said, do not file an amended return. We will review it on our end. We will handle it, and then we will issue a refund. So the IRS just wants to let you know they've issued another refunds based on this adjustment. They've now at this point given, those refunds have totaled more than $510 million to those who paid taxes on those unemployment monies on that unemployment money who shouldn't have after this exclusion passed in March. All right, the other thing that they came out with is they wanted to remind y'all that this year there is a special tax deduction to give up to a $600 charity adjustment, even if you don't itemize. So let's circle back. We talked about itemized deductions. Typically, your charitable contributions, both cash and non-cash, go to your Schedule A itemized deductions schedule, okay? And they get included with your mortgage interest, your local taxes, your state and local taxes, all that stuff. And if it exceeds your standard deduction, you itemize. Well, a lot less people itemize as of the 2018 Tax Cuts and Jobs Act because they increased that standard deduction, right? So a lot of people aren't benefiting from charitable contributions anymore. So on your 2020 tax return, they allowed you to take an adjustment of up to $300 in cash contributions per taxpayer on your tax return. Meaning if you were married, you could take a total of $600 as an adjustment, even if you didn't itemize, right? Because if you itemized, it's on your Schedule A, you're getting it. If you didn't itemize, you could still benefit from that. They call it an above the line adjustment that, excuse me, an above the line adjustment so that you could benefit from giving those cash contributions even if you weren't able to itemize and you take the standard deduction. Well, in 2021, they've upped that amount. That amount this year is $600 per taxpayer. So that is $600 per taxpayer, meaning if you are filing married, filing joint, you can take up to a $1,200 adjustment for cash charitable contributions. Cash, you guys. So it's not your Goodwill, your ARC, your thrift. It's not those adjustments. It's cash only. And just like normal, you guys, you got to make sure this can be substantiated. You can't just be like, oh, I'm sure I gave money. If you were to ever, fingers crossed, if you were to get audited, you would have to pull those receipts. So it does have to be actual, you have to be able to substantiate it if you get audited. But yeah, so that's a nice little thing that they put in there. And I think it's because, people are still giving a lot, trying to donate what they can to organizations. Quick reminder, it does have to be a 503c, I can't remember the letters. It has to be a legit nonprofit. Okay. It can't just be on a GoFundMe or money you gave to the guy on the corner. It has to be a legit nonprofit organization, but that is there. All right. I don't see any questions yet. So I'll just kind of keep rolling through updates. We have started to see people get their money for the ERTC for this year. I still am not sure how we're doing on amended 2020 941s where we were asking for money. I didn't have to file any amended 941s for 2020, you guys, for any of my clients to go back and get the ERTC. But 2020 funds for originally filed 941s have started going out or have been going out, but we are seeing more and more payments being made. Quick reminder on ERTC, because it's been a while for some of us, right? So with the ERTC, guys, that is the Employee Retention Tax Credit. And what that was, it is a credit for those of us that saw a decrease in, receipts or had to shut down or any of those things. It was available in 2020 under different rules than in 2021. In 2021, you have to show a decrease in receipts over 2019 of at least 20%. So at least a 20% decrease each quarter. They look at it by quarter. And then in a quarter where you have a decrease, plus the quarter after, even if you don't have a decrease anymore, but you can get up to a 70% credit on employee wages. Okay, 70% credit up to $7,000. Meaning any employee you paid over $10,000 a quarter, you're capped at $7,000. All right, but you were able to take that credit, keeping in mind that you did need to make sure that those ERTC credit payroll dollars stayed separate from any payroll you used PPP funds on. If that's you, definitely get some tax advice help to make sure you're doing that right. So the ERTC, it was a payroll credit. So it's a credit that you filed for when you filed your quarterly tax returns, right? Your quarterly payroll tax returns, excuse me. So those 941s, you may file them, your tax preparer may file them, your payroll company may file them. If you have a payroll company, they're filing those 941s. So most payroll companies were able to, you could request an ERTC report to see if you qualified for this ERTC. And then if you did, they would they would help you calculate how much you qualified for, and they would submit the credit with the 941. There's a new line on the 941 for that ERTC credit. So we have started seeing those payments being made. So that's really exciting. Let's see. No questions there. No questions there. Okay. So just a few more things. We might get out of here early today, you guys. Excuse me. So we talked about ERTC. Quick reminder on PPP, you guys, that those, because we're in forgiveness now, right? We're talking about forgiveness. There was our first round of PPP loans that were given back in 2020. We had a potential second round given at the beginning of 2021. Both the requirement for that, for repayment or for applying for forgiveness, is 10 months after your covered period ended. All right. I believe the last second round of PPP loans were given out maybe in April of this year. Okay. So April, your 6-month covered period would have ended May, June, July, August, October, which means you have 10 months from October to actually get that forgiveness filed. So you've got some time. However, if you had a PPP loan in 2020, chances are that forgiveness needs to be filled out if it hasn't already. Okay. Let's see. Ernie says, hi, Ernie. So Ernie says, please talk about buying an electric vehicle. What do you want me to talk about? I'll see what I can do. I'll talk about like the most common questions. So with an electric vehicle, you guys, I'll leave that up there. So when you buy an electric vehicle, there is a tax credit, and it changed. I'll have to look because I believe they changed something in 2021. But you get a credit on your return, on your tax return for a portion of that purchase price. Now it sometimes gets tricky because some dealers actually handle it and take care of it for you on the back end. It's weird. I had not seen this in. I'm trying to think. It had been. I mean, this credit's been around for a few years, and we had always dealt with it on the tax return. And then a couple of years ago, I had a client, and the dealership handled it on the front end. It was new, and it was so some dealerships are handling that. The thing to remember about this credit, you guys, is that there's a certain amount allocated to each manufacturer. And I believe October 2021, the Tesla credit ran out. I think that's right. That sounds right. But if you're buying other manufacturers, that credit's still around. That is something, Ernie, I'm going to make a note, and I will talk about this in depth next week, because there have been a lot of changes that have come because of the credit phase outs, because of those limits that have hit. There's been a few changes to it. There's state credits as well. So let's talk about that next week in depth. Where's my pen? Okay, so we will start off next week jumping into that, and I will get into the little details about that because it's important. Because I know a lot of people, especially now, they're getting enticed with buying that electric vehicle because of the credits. And do remember, guys, it is a credit, not a deduction. I will tell you that right now, meaning it is dollar for dollar back on your tax return. Okay, it is not a deduction, where you spend $1, which saves you whatever your tax rate is, right? meaning you spend $1 and you're in the 25% tax bracket. That is the 24% tax bracket. So you save 24 cents on every dollar you're spending. This is a credit that is a dollar for dollar credit. So it is a big one out there. So definitely something worth considering if you are actually looking to buy a new car, and specifically to buy an electric car. So we will talk about that in depth next week. I have a note to make sure I'm up, get all the new up-to-date stuff that's come out in the last few months. To make sure we're advising. And which brings up another quick thing, you guys. We're coming up on the end of the year, right? It is November 4th, and we have 2 months left in the year. And so we will, here in the next week or two, if you're a client of ours or if you're on our newsletter list, you will get an email talking about year-end tax planning if that's something that interests you. And what that does, you guys, whether you do it with us, you do it with your current, if I'm not your tax preparer, you do it with the tax preparer, or you even somehow kind of do it by yourself. But let's just talk real quick about what tax planning is. All right. So when you do your tax return, right, next February, March, April, whenever, right, you do your tax return, whatever it's due, or whenever you do it, right? And at that time, you do your tax return, and what happens is it's a reconciliation. Okay, your tax return is simply a reconciliation of what tax you were actually responsible for in the tax year versus what you actually paid. And whether you have a refund or your balance due is either you underpaid during the year or you overpaid during the year. So you either get money back if you overpaid, or you end up owing money because you underpaid. Okay, what tax planning does at the very minimum, or very basic tax planning, looks at your tax picture, okay? And we look at it and we see how much money you've made, how much tax you're going to owe, and how much you've paid, so that before the end of the year, you know what to expect, okay? Few things. First, by paying in before the end of the year, you will save yourself on some penalties and interest, okay? The second part, and the big part that really is important to me, is chances are if you owe taxes on money you made in 2021, you're going to have the cash in 2021. You're a lot less likely to have it in March, April, May of next year. Typically speaking, right? I know there's exceptions to that rule, but generally, you made the money now, you're more likely to have the money now. All right. So knowing how much you owe and either paying that in or putting it aside so you don't spend it is really important. All right, so that at the very bare minimum is what we do. It also gives you guys the opportunity to see what your tax liability is, see what you're going to expect, and see if there's any way to lower it, right? Sometimes a really big, easy one is, we're planning on buying a piece of equipment, or we're planning on buying something, right? And we just want to know if we should do it this year or next year. That's a really simple question, really easy with some tax planning to decide, should I buy it now because I needed the deduction and I need to lower my taxes this year? Or should I wait because I'm sitting pretty this year and maybe I'm more likely to need the deduction next year? All right, so that tax planning piece really can come in handy, specifically for my business owners, or which if you're in my money, tax, and finance group, you're a business owner. Typically, but it's really good for my business owners or my people whose income fluctuates. Maybe you work on commission, maybe you have rental properties. So that's kind of like running a business, right? So when your income fluctuates, it's important to kind of know what your taxes are before you have to pay them. The other piece, so that we can, potentially lower our tax bill, either by accelerating some expenses or by making sure we're maxing out certain tax deferral and tax beneficial accounts out there, right? And tools that are out there, our retirement accounts, our college savings accounts, whatever they are out there, making sure we're utilizing those if we have the cash flow to do so in order to lower our taxes. All right. So, okay, cool. So other than the electric vehicle, which we will talk about in depth next week, doesn't look like we have any other questions this week. So, all right, cool. So you guys, it was great to see you guys again. I'm glad to be back with you guys. And I will chat with you guys next week. All right. Have a good week, you guys. Bye.